Lots of juice to share today, so glad everyone could hop on today.
How many of these are you doing, John? How many? I'm sure you're doing these in person as well. Like, you ever get in front of the conferences?
Yeah, so I've spoken in Hong Kong, Sweden, Berlin, Paris, every major U.S. show. I can't even tell you how many webinars I've done. This is, I don't know, probably at number 100 or something. It's been doing it quite some time. And then, I mean, especially through COVID, that's all I did for, a year straight. But yeah, no, it's, this is a labor of love. And, for those of you who don't know that are on here, oh, hey, Zach, good to see you, buddy. I'm second generation storage. My dad started building in 1969. So I've been drugged around the industry for quite some time. So it's like a normal dinner conversation for me. Just happy to be here.
All right. Well, why don't we dive in then? Starting to level off here. So, for those of you who've been on since 2:00, John he's an industry leader. We brought him on today, and we've organized this webinar to kind of dive into some macro trends in the market, and then to talk about maybe how to respond to them. It will not always be relevant, as we'll talk about. Things are sub-market by sub-market, but the Lindsey Group is a valued partner of ours, and they're an industry vet. So there's no better group to kind of talk about the market than John and his team. So why don't let me introduce White Label, give you a little background on our firm. For those of you, I think I will say a testament to the Lindsey Group reach is that as soon as the Lindsey Group sent a blast out about this webinar, we tripled our head count. So many of you probably have the background on the Lindsey Group, so I'll tell you about White Label. We started White Label a couple years ago as operators ourselves. Myself and my co-founder, Alex Hartman, we started a company called Local Locker back in 2018, where we do sort of retail installations of self-storage facilities. And when you're operating stores that small, you naturally have to think differently about how to manage them from a technology standpoint, from a staffing standpoint. The revenue is not enough to justify having people on site. And while we built this technology stack and sort of operating practice from scratch, we started to look around the industry, and we saw that there was no real professional service provider on a national scale for non-institutional owners. You've got at the top of the pyramid, you have REITs. At the end of the day, their primary focus is deploying capital, and as a result, their third-party management arm is not super client-focused. I mean, they're gonna force you to rebrand your facility. A lot of what their costs are a black box, and how they do things, you're not gonna have input into. That's kind of the one end of the spectrum. And then you have sort of regional operators that have similar problems. They tend to be not pure third-party players, and they can't follow you around the country. So you might be limited in your options of where you can bring them. So we sort of looked at this and said, look, we can eliminate a lot of the costs in the stack because we built a lot of the technology ourselves. We think we have a new approach that allows us to kind of think about staffing facilities, in a bespoke way, and go look at a store and not treat every store the same way. And when we launched that platform, there was a lot of pull. We launched it in end of 2022, and now we've got over 200 facilities under management, ranging from a 45 unit boat and RV facility to a 1,200 unit big box conversion. So we do a little bit of everything. And as a result, we have good relationships with some of the other groups in the industry, and the Lindsey Group is one of them. So I'll let John talk a little bit about the Lindsey Group here.
Yeah, no, thanks again for having me. Pleasure to be here with you guys. I've done a lot of work with you all over the past couple of years, and love to see the evolution of the platform. And I think, again, through a big change globally and stateside was a ripe opportunity for you guys to come into this. So love to see the change, love to see the disruption. As I said earlier when I hopped on, my name is John Lindsey, co-founder and president of Lindsey Self-Storage Group. Family's been in the business since 1969. My dad was a developer. I grew up pouring concrete as a kid. Coming out of college as a dad, I love storage. I hate pouring concrete. So I launched what's now Lindsey Self-Storage Group. We do brokerage throughout the world, done projects Southeast Asia, Europe, UK, Latin America, and the US, pretty much everywhere but California. It's easier for us to do business in other countries than it's California sometimes. But we've got a team sprinkled throughout the country. We've got team members in Denver, Dallas, Minneapolis, Tampa, Raleigh, Durham, Charleston, you name it. So we've got a pretty broad reach. We're thrilled to be here and be a part of this webinar today.
Great. Thanks for joining here. Before you dive in and into the market, I do want to say we've got an open chat here. You can either ask through the chat or through the Q&A. People who join the webinar here, like we want to make this, I think having this be interactive is lends itself better to the webinar format. So feel free to speak up. We already have one comment. It is simply an LOL as an abuse of the Q&A. So let's try to get some thoughtful questions. But we'll let John dive in here.
Yep. So I'm gonna hit the agenda real quick. We'll dive in. As Peter said, feel free to throw something in the chat, ask Q&A. If I see it, I'll get to it. If I'm going to answer it soon, I'll let it linger for a minute, but I appreciate the opportunity to be here. We're going to hit market overview, talk about the REITs and their rate games that kind of play in the market today. The one big beautiful bill, which we've all heard a lot about as recently. 2025 outlook. You're halfway through the year. What does the second half of the year hold? And then we're going to dive into what Peter's got for the rest of the time. So we're excited to see what we have here. So Lisa, if you can kick us off, flip us over to the next slide, that would be tremendous. No more. There we go. So I think high-level trends we're seeing today in the market. As the market starts to stabilize and we're seeing this massive tech integration, we're going through this huge momentum swing right now. We are having new AI adopted, remote management such as white label, heavy data analytics. In the past 15 years, the swing from this dinosaur age industry to now has been wild. It's been really cool to see. And I think, again, as I mentioned just a couple seconds ago, COVID really forced this tech integration to the space. It was probably coming anyway, but not at the rapid scale that it was hit. We were forced to think differently all of a sudden, which I think has boded super well for this space. But now, even in the last 6 months, AI has been wildly impactful to the space. People using ChatGPT day in, day out, but the integration that I've seen platforms use on their backends, whether software, underwriting, management, rate analysis has been crazy to say the least. And I think we're just scratching the surface of that, to be honest. So super excited about that. I can answer questions later on that if people have questions. But I think also too, rate recovery across the metros has been awesome. Year-over-year rent change was almost flat on a national average, but in 17 out of the top 30 metros, we're seeing positive climate controlled rate gains, which is awesome. Summer of 23, we had those back-to-back rate hikes. Coming in 24 was a really tough time for a lot of operators. We were underwriting deals. We were seeing negative T12 rate trends in the teens, 20s, even 30s in some markets. It was rough. So for us to be leveling out where we are now is unbelievable. As I mentioned here, some of the strong monthly rent gains that we're seeing, markets like DC, Charleston, Raleigh, Durham really dominated that area. Some markets where there might have been a little pain point still are your Vegases of the world. And even through the June report, which just came out, I think Vegas was still down like 12%, and there's even more product being delivered. So we are seeing some cities still getting hammered. But for the most part, a lot of these markets, population growth and lack of supply from last year has really fueled and caught up to where we should be in those markets.
John, I've got a question for you quickly as you're talking about the markets that did get hammered. And I'm sure this is maybe relevant for some of the folks on here if they are active buyers. Did you see a lot of distressed sales and forced sellers? Like if you're thinking about the listings that you had over the last 2 years, were a high percentage of those as a result of poor performance, or despite poor performance, was there there may not have been over leverage to the point where people were forced to sell? It'd be nice to kind of hear a little bit about what you saw there.
Yeah, I think, we definitely had a couple owners that were ready to cut bait and maybe not forced to sell, but they also recognized the uphill battle they'd face. We had one owner, he's like, look, I've got, X 100 million in another asset class. This is my one storage facility. I'll just cut bait and just I don't want to write more of a check to the bank. He's like, for me to spend money on this property and lease it up in 5 more years, it might be worth what I bought it for. He's like, my opportunity cost of dumping this asset now is a much better use of my time, energy, and money. So I think a lot of intelligent operators kind of had to make that tough gut decision. We've also underwritten a lot of sites that are well underwater, but it's still tough for some owners to bite that bullet. And I think what will be interesting as we see balloons come up this year and next year, how many of those owners are in a place where they can afford the refi or have to sell? And on the other side of that, thankfully, there are dozens of buyers that have capital stacked away for prime buying opportunities. There's no lack of buyers or refi or bridge if someone's in that position. But I caution everyone this, if you're even questioning your situation with your asset, the time to talk about it is 6, 9, even 12 months in advance of when that due date is, because it's really hard for me or a bank or anyone to help you when there's 45 days left. So, we've talked to a lot of operators. If you give us enough time, energy, we can make sure you get with a great management company like White Label, maybe pump things up before you have that time at sale, or give us enough time to kind of figure out how to navigate your scenario and find the right partner for you through that. Does that answer your question, Peter, for what we've seen?
Yeah, that's helpful. I mean, I do have one follow-up, which is like, have you seen lenders, are they flexible? Are extensions out there for folks? Or, obviously you don't want to leave 45 days left to make that choice and find out from your lender. But, what have you seen on that front?
We've seen, a lot of lenders are willing to work. I mean, obviously lenders don't want the asset at the end of the day.
Yeah.
It depends how strong of a borrower you are. That's what it really comes down to. And again, like, you're not going to get the rate you got in 21, but they may be willing to extend term a little bit or help you refi in some capacity. So I think lenders are willing to work today, but it all comes down to how strong you are on paper.
And to tee it up for you, will you work with lenders on behalf of owners? I mean, are you going to get involved in that process? Or
we have a very good network, but beyond an introduction, I always leave that to the specialists.
Okay. All right.
Yeah. Great network. Happy to make introductions, but then we let them do what they do best.
Perfect.
So,
Perfect.
On that note of kind of, how assets are performing, things we're seeing, only about 3% of the self-storage industry is currently under construction right now, which is great. It was 5, 6, 7 in, last year before it. So it's finally trending downward, and even as Jay mentioned here in the chat, and it says here, Phoenix, Vegas, huge supply issues, huge rate pressure. Charlotte's had a ton of new product delivered, but also conversely, it's one of the fastest growing markets in the country. So it's more of just a math equation of when does this balance out? Is it 2 years? Is it 5 years? But that's the dice you got to roll at the end of the day, is do you have the stomach or the balance to roll that interest carry in the interim? As far as top and bottom performing markets, DC 4% year over rates, and then Austin and Vegas, again, sharpest decline at 3 and 2.8. And as I mentioned, the June numbers came out and Vegas was down even further beyond that. So I think we're going to continue to see those pressures in those markets for quite some time. As far as REIT rate performance is concerned, if any of us have operated in any major markets near any of the REITs, we've all felt the pressures. There's this huge delta between what they're advertising and what they're actually charging. And it's about 14% through end of last year, this delta we're seeing. And what's crazy is their year over year NOI growth is unbelievable. And they've been able to crush it and perform it like that. The problem is it works when 1 or 2 companies are playing this game. But when everyone plays it, it's this race to the bottom. And we've seen it really start to hammer a lot of these markets. In theory, ECRIs work very well when pushing them against lower street rates. But I think, again, as we saw in California with the bill that's been faced, this could be a further issue nationwide if we get too aggressive with these practices. So it'll be really interesting to see how this plays out. California has made themselves pretty firm on where they stand in this issue. I have a feeling that other blue states will follow suit. What I don't want this to become is a national rate control problem. We've seen that in a lot of multifamily markets. I fear it could happen in storage if people get too aggressive or greedy with these practices. So I say all this, I think there will be a lot of legislative work done in the next 12 to 18 months that will shed a lot of light on this issue.
So quickly, if you are underwriting a new facility and you see this, the web rate, the slash rate, and the discounted rate, should you assume a 15% premium on in place? I mean, how should you go about it? Because it creates a lot of noise. It makes it hard to really understand how a market's doing. What do you guys?
It's one of the biggest issues that buyers, brokers, developers, everyone faces, because unless you have actual in-place data in the market, it's tough. And I've seen a spread of 40%, 50%, it could be massive. We usually pin 15 to 20% at first glance. Thankfully, with our network, we probably know at least one operator in certain markets to give us some guidance as to where in place actually is. But I advise people, I mean, if you can get a deal to pencil off of, street rates, the way things are going now, it'll probably look really good when you actually see the in-place data. So, leverage relationships, talk to other operators. I still think one of the coolest things about the space is that operators are so candid and willing to share as far as what's been happening in the market, how they're doing. Because again, no one wants our product going if there's no room. So make sure to have those conversations. Hire a consultant. There's great third-party firms that work out there, or your management company, like White Label, will go do that for you in this market if they have the data available. So I think this will be really interesting to see how it pans out over the next 12 to 18 months.
And Brian asked a clarifying question. Is it 41.4% or 14.1? To me, it looks like it's 14.
Oh yeah, it's 14.1. Pure
and
type.
so the way that, just talk about how that plays out. So you see a rate on the site, right?
Yep.
And how quickly does it roll? Like, in effect, how does the REIT roll you onto that higher rate?
Yep. So, I mean, within 6 months, you'll get your first rate hike. Within your next 6 months, you'll get another. I mean, they pretty quickly and pretty aggressively can.
Yeah, I've seen 3 months. Like, it's an introductory rate. The web rate is never going to be the rate you're going to sit on for a while.
No, 3-6 months, another one, another 6 months. I mean,
we'll talk more about that when we talk about pricing.
Yeah. So, next slide, Lisa. So I think the biggest piece of legislation, obviously, this year so far is the big beautiful bill. I mean, it is, no matter where you're at, this has been huge, impactful piece of legislative work going through in the U.S. here. I think, relative to the storage industry, the biggest thing that could be beneficial, and again, I'm not a tax professional nor an attorney, but the 100% bonus depreciation could be massive for your facility. All those qualifying improvements in the first year, your HVAC, your windows, your doors, all those movable pieces, you can hire a cost seg company to come look at these for you. There could be some huge upfront tax savings, which gives you this net present value, that cash to go deploy elsewhere and grow your portfolio and buy other sites, things like that. So I think this is one of the biggest pieces that will absolutely be like a rocket ship to the storage industry. Buyers, PE funds, management companies, wherever it is, this will really help restructure a lot of capital moving forward with new projects. So talk to your tax professional, your attorney, hire a cost seg company if you're really interested in learning more about this. But I think this is one of the biggest things that could help take off the space. And I personally am really excited about what it could do for the storage industry moving forward.
What percentage of a storage facility would be classified as FF&E that you can?
Well, I've seen, I've seen some groups do 20%. I've seen others do up to 80%. It depends on the interpretation of the cost seg company and what they think will actually, fit within that. But again, based on the projects that we've seen from this, it's a very healthy amount of upfront depreciation, which again, just frees up your liquidity moving forward into other vehicles. So again, I think there's a number of professionals that can help you guys work through this. If anyone needs recommendations for groups we've seen that have done a lot of work in the space, happy to answer those questions later. But I would certainly research this as much as you can. I think this will be one of the most impactful bills to our sector in years that we've seen. So personally very excited about this. And there were a couple of storage guys who are in Congress that helped vote this through. So you can thank them too. Next bill. So 10-year treasury still floating high. We've seen a sniff of it dip under 4 this year back in early April, but it's kind of teetered around that 4.5 range. Obviously, a lot of this is waiting for, tariffs. We're waiting on the Fed to react. It's a little frustrating to see where it is. It makes it tough to borrow. I mean, back when we were borrowing 3-4% debt, life was good. Having the 10-year this high does make it tough to get affordable debt, not impossible. I do expect this to pull in significantly over the next year to 3 years. When you look at the forward SOFR curves and all the projections, they're saying anywhere from 100 to 250 basis points in the next 36 months. So I think a lot of this will settle down as we kind of see a lot of our current geopolitical status kind of peter down, and also see how the Fed reacts. We have a meeting next week, one in September. So a lot to behold over the next 30 to 60 days. Lisa, next slide, please. So I think, as far as understanding the current dynamics of storage, DXD wrote a really good article on kind of this current state of the market. If you guys don't follow DXD's articles, they do a great job with this. I think there's a lot of factors that pull into this as far as the storage demand. This kind of goes back to the core basics. 50% of demand is due to moving, 33% due to space constraints, and the rest covers all your general commercial residential needs, small business, redoing your home, things like that. But I think the biggest piece of this, and you'll see it on the bottom right-hand corner of this image, moving activities decreased to its lowest level in over 30 years. Think about that. That is like since the 90s, this is the lowest amount of moving we've seen, which is pretty crazy when you think about 2008, global financial crisis. So pretty big stop in what provides 50% of our demand within the sector here.
Is there any data on what is leading to that?
So I think if Lisa wants to click over the next slide, I can kind of walk you through it. But I think, as we're looking at this, a lot of it has come from, these headwinds we've seen in the space, the spike in interest rates, home affordability is at an all-time low. The lock-in effect, as it states here, 56% of mortgages currently have below a 4% rate. Americans are golden handcuffed, period. And it's interesting because I think that holds only for so long, though. We're going to see people eventually get the itch to move. People are going to want to change jobs. People are going to have to get out of that. It's hard to ignore the liquidity slug that's tied up in a lot of these assets. And so at some point, we're going to see this start to unwind. I think even a 25 bip cut would create some real socioeconomic headwinds for the space, just give people a little relief. If we can get back into the fives for mortgage rates, I think the whole economy starts humming again. That's enough of a gap to where people are like, I'm not at 7 anymore. Maybe I'm at 5.5. I can stomach that. So I think it's going to take that to get people moving again. I think we're close. I really feel like we've had our soft landing and we're coming out of it now. So, as we start to go through that, and again, we saw that slight uptick in November. It's continued uptick since then for home sales. I think we're going to start to see increase in home buying, which will really start to kind of further this tailwind for self-storage here. Next slide, please. So I think that moving forward, as I've said, I've been optimistic for quite some time. On top of just kind of the headwinds around the space or tailwinds we're seeing around the space, new homes are smaller since 2016. New homes decreased by about 12%. More demand for storage, which is awesome. Next slide, Lisa. And I think, as we've seen, renting fuels this huge demand for self-storage. Renters have a 2 to 3 higher propensity for renting storage versus homeowners. And again, with a record high of Americans renting instead of owning because of this home affordability issue, we're going to continue to see this huge demand for storage. And again, I think as far as, we see this continue to take off, homes get smaller, harder to own a home, more people renting longer. And on that too, you see this huge lag generationally. The millennials compared to prior generation, we're on a 4 to 6 year lag for our first home purchase. Think about how much that means as far as the rental market, storage market moving forward. And I assume Gen Z and Gen Alpha are going to be in the same category. I don't think they're going to be buying homes any sooner than we are. So I think, again, that just furthers this propensity for the need for self-storage for years to come here. Next slide, please. So as far as new supply is concerned, I think we've all felt it, seen it ourselves, experienced in our markets. Similar with housing, higher rates, higher construction costs, super complex environment we're in. We saw the craziness come out of the GFC, this huge boom in the storage, crazy amount of development going in throughout the country. Everyone had sub 4% debt. Life was good. And then you can start to see this huge fall off. We get that first rate hike in 22, and it has been impactful. We saw 275 bip hikes in 23, back to back within 30 days. And we have felt it ever since. And then last year was the lowest amount of supply delivered in the past decade. It was crazy how little storage was developed last year. So now with this, lower amount of supply, and we're going to start to see a lot of these markets play catch up and start to absorb all this product that was built in the late teens, early 2000s. Next slide, please, Lisa. So again, you can see this as development slowed, we're seeing this huge shift in the market. And on the right-hand side here, that completion rate, you see we were building 1,400, 1,200, 1,200, 1,100, 1,200. And then in 24, that year to date was about 400. We finished around 500. I mean, it was half, if not a third of where we were in prior years. So all of that is great because it starts to see this retreat from the market, from developers. It puts operators in a better position. We're not seeing these huge, T12 rate declines anymore. We're seeing absorption. Because again, a lot of the markets that were really oversupplied were some of the hottest growth markets in the country. Your Charlottes, your Raleigh-Durhams, Tampa, Nashville, Miami, and all of those have now kind of started to plow through that with the amount of growth we're seeing in those markets. So again, it's a short-term supply issue, but it's still an issue, and it's going to take some markets longer to recover than others. There was a market in the Southeast in 21. I had a client building there. It was an $18 market when they started permitting. By the time they built and opened their doors, it was an $11 market. It's now rebounded to 15, 16, so it's coming back. But when you pro forma 18 plus and you open your doors, it's 11. That's a tough pill to swallow. And I know that there are a number of developers I've spoken with that have been in a similar vein. So again, not scared of these markets. It's more of just understanding the terminal value of the asset and the time it's going to take you to get there. I think the groups that are truly building the right reserves to stomach these environments are going to be the ones who really survive long term here. Next slide, please.
Assuming we have some buyers, active buyers in the market, or people who are maybe trying to be in the acquisitions world and for first time, do you have, what are good ways to track absorption, oversupply, pipeline? I saw you reference Radius Plus there. Could you talk through some of the vendors there just so people can kind of track these?
Yeah.
I'm sure you guys are a resource as well if you've actually, once you've probably targeted a market. But for somebody who's kind of taken this from the top of the funnel.
Yep. So I think there's a ton of great consultant groups, Eric Bloom, BMS Group, Bob Copper, and then obviously leaning on management companies in particular. If you're, looking at sites, get great pro formas from White Label, get quotes from them, lean on them, lean on developers who build in that market, operators who build in that market. And as you said, call us, call a broker, call any broker you want that's done work in that area. They probably have historical actuals in those markets to help paint a picture, or again, are aware of, all the developments going on. Tract IQ, tremendous data, Store Track, great data, Radius, great data. It just depends. They all have little niches they fill. And I think some hit better data points than others, but there's a lot of great resources out there. And I think, as Mel Gibson said, you aim small, you miss small. And I think in this space now, we're so far from the build it and they will come model that my dad came from in the 80s, 90s, and 2000s. You got to make sure you're on the mark now. And so I think really taking that into consideration, drawing as much data as you can, puts you in the best light moving forward. So great question there, Peter. As far as, bull or bear, where we stand in this market, the last time we saw this slowdown development was after the GFC. And it's that super drastically impacted the number of facilities that were built. Not like the 2000s were exploding, but they were doing quite well. First time we saw huge capital injections from groups like PE and GE Capital and things like that. So we saw that first slowdown, as did everyone else through the GFC, kind of like we did with COVID. Next slide, please. Oh, one back. There we go. But limiting supply drives stronger pricing. As I said, we see that absorption in the market. We see occupancies level out. We see prices as a result start to follow suit. Again, in 2009, occupancies were above 90%. And I think we really going to see that push come forward here, create super strong pricing power for owners and operators. So we see this acceleration of rates through the early teens. Occupancy as well follows suit just due to the lack of construction all of a sudden. It may take us another 12 to 24 months to get there for absorption to happen because there was so much product delivered. But as that product is absorbed, I think we'll see very similar trends to what happens here, both with rates and occupancy. Next slide, Lisa. So 25 and beyond, again, national trends matter. I tell people all the time. We're seeing across the board. I think we're feeling the tailwinds. Life's good. Storage is back. We're cruising. Things are awesome. But it really comes down to your sub-market data. Your 3 miles is the most important thing you can look at. Because again, it's tough to blanket DFW. It takes 2 hours to get from one side to the other. Raleigh, Durham, same thing. Nashville, Tampa. But as a whole, we've seen this great tailwind in the space. We're seeing a lot of leveling out. Rates are good. Occupancies are coming back. Both buyers and sellers are active. This is the most active year we've seen since 21. We're super bullish on the space moving forward. I think there's a lot of great opportunities.
Yeah, that's a perfect segue. We wanted to sort of piggyback on this presentation, especially how you ended it with emphasizing the point. Lisa, if you can go move on one here, is oversupply of self-storage in Miami doesn't mean isn't a developed opportunity in Vegas. The macroeconomic trends, it's important to follow these things, especially if you're looking at a new acquisition or just thinking strategically about what to do in your market. But submarket by submarket, there are very different things going on. In a tertiary market, a new development of 150 unit asset could double the supply within 5 miles. I mean, in some of the markets that we manage, and totally change the pricing dynamics. So though it's, looking at interest rates and looking at national development pipeline averages is helpful, at the end of the day, if many of you on this webinar are owners and operators, you care about your stores and your submarkets. So we're hoping to kind of share some of the things that you can do to operate within the market dynamics that you face. So start with a market where occupancy is high. I mean, it looks like that's either the case right now in many of the metros, or will be the case if supply is absorbed. And the name of the game, when you have a facility that is full, is ECRI. That's not to say you shouldn't do it during lease up, but moving rates on tenants is an important part of revenue management, because if you have a full facility, that means you have inventory that you're not selling, and you have opportunities to push rates. It's easier to push rates on a full facility than it is on one that's empty or in lease up, especially during the lease up phase when you're trying to generate reviews, trying to generate some solid SEO performance. So coming up with a thoughtful strategy around pushing rates is important. And I want to sort of revisit the REIT comment that John made earlier, which is running ECRI doesn't mean selling units for free and pushing rents every 3 months. Unless you own a store, unless you're on this webinar and you own a store that is managed by one of the REITs, it's really hard to play that game, and you probably shouldn't, especially if you're in a market that's a secondary, tertiary market that doesn't have a ton of demand. Like, you can churn through the demand in your market pretty quickly if you start pushing rates on people and pushing people out. So one of the reasons I say not to do that, one is, and we'll talk about sort of price war, this is sort of a secondary thing, but if you drop your rates, as many of you will do, you're looking at the competitor rates, your competitor might drop their rates, and that can create just a negative cycle where your entry point is going to be cheaper than somewhere else. But more importantly than that is, if you aren't running ads, if you don't have a national brand like Extra Space or a huge marketing budget, when you increase rates on existing tenants, you will churn customers. It's not a bad thing. If you have 100 units and 98 of them are rented, and you come up with a strategy for pushing rates, and that results in moving 15 tenants 20%, and 10 of them leave, you're in a pretty good situation there. You now are left with 88 units of your 100 units left, where 10 of them are now paying 20% more, and you now have new inventory that you can lease in a market where you probably don't have to discount your units. So it's okay to free up some inventory. But if you push rates every 3 months in a market where you can't backfill those units, you're just going to end up in a situation where you lose occupancy and it's hard to climb back. So I think something for a non-institutional brand in maybe a non-urban market, coming up with somewhere between 9 and pushing rates on tenants that have been there maybe a minimum of 9 months, and capping the increase at like 50%. If they come in at this entry rate, I wouldn't push them more than 50% of their rate. It leads to bad reviews. It's hard to retain them. So you just need to be thoughtful about that if you don't have an endless supply of new tenants coming in. And on top of that, it's not just as simple as running ECRI and forgetting it. You should have a thoughtful strategy around retention in the case that you do experience higher churn than you expected. So that's whether it's a customer service agent or an on-site manager, preparing that person to respond to somebody who's leaving as a result of that increase. For example, if somebody says, "Hey, I'm just not going to eat this," you may say, "Look, meet them halfway." In that case, you could still achieve an increase and you can retain that tenant. Or maybe you just let them stay at their rate because the other 9 tenants of the 10 that you pushed actually accepted it. So it's not just about the rate increase, it's about how to respond to it. Facility expansion, we manage for a lot of folks in rural markets and even in urban markets where there is an opportunity to increase capacity at the facility. Obviously, you need to be zoned for it. You need to have buildable square footage, but look out in front of where the next 6 months, if you think you're approaching a 90% occupancy, probably an opportunity to start thinking about adding new supply. I think that's the time when you want to look at a Radius Plus, see if anything else is coming online. This is market by market, but I think it's always better to be at a full facility when you're thinking about expansion than one that's not full. And then finally, promos and discounts. I think everybody remembers coming out of COVID. You didn't see a lot of these 75% discounts. People were running ECRIs. You could get people on entry rates that were high. It's not just, you shouldn't just be thinking about your own facility when you're thinking about promos, but what you do with your promos and your rates will engage it will engage your competitors in the market within your 3 to 5 mile radius. They're going to be looking at your rates and they're going to respond. So again, like John said, it's possible to be in a race to the bottom, as the REITs have led a lot of people in that direction with these games they play with rates. But when you're operating with some bargaining power and some occupancy, it's probably time to start thinking about removing discounts and promos, and hopefully you can get the rest of the market there as well. We do have a question here. I'm actively looking to buy a self-storage facility in the next 3 months. No, that's not a question. That's a guy looking for a lead. All right, we can move on to the next slide here. And then flat rates. I mean, obviously, this is probably what more people are familiar with over the last couple of years, at least more so than the prior 2 to 3 years. I think this is when you want to start to think about tooling and actively managing your rates. You don't need to sign up for Veritech or ProRise or StoreTrack to do dynamic pricing or to be active with your rate management. You could do it manually by just looking at it once a day and just setting rules for yourself around, if I'm at 80% occupancy, I'll be at 80% of street. If I'm at 90%, I'll be at 90%. And you can set up your software to kind of follow those trends. It can remove some work from your plate if you're on an FMS, and allow you to be looking at your own inventory as a driver of pricing strategy. Unit mix, we have a lot of, especially if you're at a drive-up facility, in many cases, there are these bankers unit mixes that have like too many 5x10s and 5x5s that have higher theoretical prices per foot, but don't lease. if you've got, a 30 or 20-foot row of units and you've got walls between them, it is actually possible to move those walls out. I mean, I would start to look at where is their demand and can I change my unit mix to match what's going on in the market? We see that all the time. It's not that hard depending on the type of facility you have. And even if you're in an indoor climate controlled facility, in many cases you have these non-load bearing walls and lockers that are divided by sort of corrugated steel panels. In those cases, you can take 2 4x4 lockers and make a 4x8 or go even bigger than that. Look at your inventory, look at what is sitting vacant and think about maybe trying to understand where the demand is.
Peter, we got a great question that I think ties in well with that. Sam asked, what would you guys consider stabilized occupancy to shoot for? And I think especially when you're looking at refining your unit mix, what are you guys seeing as far as a good, healthy target for physical and economic, in the stores you guys are managing? Yeah.
I mean, I would start. I heard when we first got in the industry that you want to manage to a 93% economic occupancy. And I think a number like that makes sense. I mean, I would think about it this way. As soon as you have unit types that are 100% occupied, when you are spending money on advertising, or even not spending money on advertising, your conversion rate on site visits is going to go down because you lack a diversified inventory. So, if you have a facility that's 50% occupied and one unit type that's 100% occupied, then you just got a unit mix problem. But if you're, it's usually going to be around the mid 80s to the low 90s that you start to see certain unit types go vacant, and that is when you want to start manage. That is the prime time for ECRI if you're not already running it. But I would say, stabilized occupancy in the storage world is high 80s, low 90s. Depends on the size of the facility. I mean, if you've got in many cases, we're talking operators who've got less than 100 units, and one unit can really swing the inventory pretty quickly. So if you lose 5 units on a 60 unit facility, it's not hard to rent 5 units, but it may look like a big swing in occupancy. So I'd be thinking about it that way. But we start to look at things when unit types start to disappear, because when somebody shows up to your website, maybe you've spent, $10 to $20 a day on Google ads, and somebody shows up and they only see a 10 by 10 there, your customer acquisition cost is going to skyrocket, and you should probably be trying to find ways to increase inventory. And one way to do that is the only effective way to do that as a revenue management practice is ECRI. So be in the low 90s. If you get above it, absolutely start moving rates. I think we can move. Oh, and then we talked about this already, but avoid the race to the bottom. You can see it. If you if you freak out and move all your rates down 20%, and you have active managers in the market, they're going to follow you, unless they're full, in which case, you probably, if they don't follow you, then move your rates back up, because you're probably not selling units for another reason. But you don't want to incite a price war. So what I would do is, if you're going to drop rates, I would do it strategically and do it in a way that sort of masks your strategy. So maybe take 1 or 2 unit types and significantly drop them for 2 weeks while maintaining rates that are higher than your competitors across a couple of other unit types, and focus on the ones that are the lowest, that have the highest vacancy rates. So just be aware of that. Like, I think a lot of people respond to the REITs by dropping rates, and it's not a great strategy. All right, let's move on here. I do want to quickly, we've got limited time. I want to make sure we have a couple questions here. So there are a number of tools that you should think about using. I'm sure many of you are aware of them, but I just wanted to have a page here to show you kind of some of the best, the industry leaders. There's FMS. In this day and age, John talked about it. Most of the FMS providers I've listed here, like these guys are great, and they will, they'll have things like revenue management tools, you just don't want to be running off of a spreadsheet. Like if you don't have an FMS provider, you're way behind, and you've created friction for your tenants. Kind of taking a step beyond that, if you don't want to do the manual work associated with both rate increases on existing tenants and then understanding rates at competitors, there are a number of players in the industry that will give you good data on the market. And then finally, a website. Like you want a solid website with good SEO, with low friction in the checkout flow. We actually have built our goal is not to be a vertical software product, but we did see there was an opportunity to eliminate a major cost in the cost stack and the technology stack by building our own website and allowing people to put their own brand on the website while increasing or decreasing friction in the booking flow. So we actually do have a website product for those that are interested. Let's see, moving on to the next slide here. Just quickly, if you want to find ways to move, I wanted to just highlight this because whether it's in a down market or a market where you see high occupancy, I think a lot of people think about investments as, or some of the line items I've added here as costs, when you should be thinking about these things as investments. Like there is adequate ROI for certain cash outlay at the facility. I think the number one thing that I didn't even list on here, but that we see with clients is marketing. They think about the marketing line item as just a pure cost. That marketing should have ROI. If you are marketing, there should be some return on investment there. You should be accelerating your leasing velocity. So similarly, if you have a facility that has some frontage, some visibility from a road, you should invest in the curbside appeal. You should invest in your signage. Those are things that market for you 24/7. You can, if you want to get away if you want to eliminate that marketing line item, that recurring marketing line item, the best way to do that is to have prominent signage and a facility that looks good and looks inviting and looks safe. So these are investments. They're not just costs. Similarly, there are ways, whether it's through paying for a better website provider or actually hiring a consultant or a third-party manager to look at the booking flow. One of the things we did with our website is if you start the checkout process, and many others do this as well, with our website, if you start the checkout process and you don't complete your booking, we capture your information, we send you a text, we send you an email, and then a customer service agent will call you to try to complete the booking. Conversion is everything. If you get, especially if you're not getting a lot of traffic, if you get 10 visitors in a day and one of them books, the other 9 that visited, if you call them and you offer them a discount, there's probably a way to get them into the facility. So that's meaningful, and it's an investment that's worth it. And then finally, tenant protection insurance. I mean, that's just a non-starter. Like that's just day one stuff. Like you can pick up 10% on your top line by rolling out some product there. And I think many of you probably have seen Safe Lease, SBOA, IOA, Bader, Store Smart, all those guys. I mean, it's pretty easy to roll that out. Let's go to the next line. Next slide. Doing a cost study. I mean, just taking your P&L and looking line by line. The beauty of self-storage is there just won't be that many line items on your P&L. We run books for many of our customers, and you don't have to do that many classifications when you're putting together a P&L, and you can pretty quickly identify where the high percentage costs are on your in your expense ratio. So look at your insurance, look at your utilities. There's probably ways, investments through at the property level where you can eliminate those recurring costs. I mean, if you're selling your property, it's the recurring costs where you're going to get dinged. It's the one-time costs and investments that folks don't underwrite. So that's where I would think about it. And then finally, staffing is the thing we're always thinking about. Many facilities, every facility should have a different staffing strategy than the next, because it's about volume of activity that's happening at the site. A 75-unit store should not employ somebody the same amount of hours as a 750-unit store. it's kind of one of the reasons that we got into this. Is like we learned that through our own business doing these urban retail installations. What I have always said is, you should separate tasks. If you have somebody on site and that person is responsible for both overlocking units, sweeping the facility, sweeping out units, and answering the phones, every moment that they're spending overlocking a unit, they're not sitting there answering the phone. At the end of the day, storage is a commodity. So that lead will just call the next facility. And I'm assuming that other facility probably has their rate similarly priced to yours. Their product is probably similar, and you're just going to lose that customer. So having somebody on site might not be worth it for you anyway. Staff that store, have somebody clean it when you need somebody there to clean it, have a call center separate from that. Or it doesn't need to be a call center, it could be a remote site manager. But really thinking about the staff is important if you're trying to think about increasing your NOI. It's a big opportunity there, especially for smaller facilities where folks have for many years just thought, no, W-2 worker, 5 to 7 days a week. It's not. There's a better way to do it. Move on to the next slide here. So one way to do this, whether it's us or someone else, is hiring a third-party manager. I will always advocate for it. Many of you get into self-storage because you're told it's a passive asset class, and real estate in general is known as a passive investment. But for some reason in self-storage, unlike other asset classes, like most apartment acquisitions firms don't also try to manage the facility. But people tend to enter the self-storage world. I think it's because it's a lower purchase threshold. There's smaller facilities. The entry, the barrier to entry is a little bit lower. That people come in and say, well, I'm going to buy this facility. I'm going to run it myself because it's a passive asset class. People come in and they pay. Then very quickly realize that you have to make choices around a technology stack. You need to think about how you're going to answer the phones. You need to understand lien law and delinquency, which is different state by state. Owning the asset is the passive piece, and collecting rent is the passive piece. But operating the asset, that is, that's a managed service. So we have always thought you should separate those things. And when you do that, you'll have somebody that is fully focused on performance in the services and component of running a facility. So that's my pitch for third-party management, whether it's us or somebody else. It creates accountability. It helps you sell your asset. You have credible books, and you have something that's easier to sell because you won't be discounted for sort of, we've seen a lot of owner operators kind of fudge the books. It's a good way to operate a facility. All right, so let's move on. A case study on this is like we took over a facility not too far from where we are here in Brooklyn, in the Hudson Valley. They hadn't changed rates in forever. They weren't selling insurance, so they weren't focused on pushing it through to tenants. And I think the key indicator of whether there's an active manager on a site, this would be kind of a trick of the trade if you're looking at a new, like an off-market deal, is how many Google reviews are there and how recent are they? So we came in with a strategy around, we're really going to focus on the tenant protection capture rate. We're going to start actively managing these rates because there wasn't a lot of active management there. They weren't pricing based on what competitors were doing. And we're going to go try to capture reviews so we can separate ourselves. We can perform better on SEO, and it resulted in 10% immediate 10% increase in top line, and we filled up the facility, and now we're in a position at that facility where we're in the fun part, which is ECRI, pushing rates on tenants and backfilling them during summer. It's a good place to be. So let me stop there. I don't think there's another slide here. I think I saw a couple questions come through. So the first one here, well, let me just start with John. Do you have anything that you would add?
No, I think, look, especially in this day and age, as I mentioned, aim small, miss small. The more competition that we're seeing getting into this space has really forced operators to have to step up to the plate as far as kind of new data, new age, new practices. So, again, buying and selling, work with a consultant, work with a broker. you got a site, please work third-party firm. Obviously, White Label does a great job. Find whoever's the best fit for you through this process. But I think especially given their broad range of product type and throughout the country, could be a great exploratory practice for you. I just think it's very hard to bring a knife to a gunfight when you're competing against some of these larger PE firms and REITs, and having the right team behind you to do that is what makes this product successful in this day and age.
Exactly. We're at 3:00 here, so I do want to answer a couple questions. The first one that I saw was, what conferences do you recommend for owner operators? I think, if you're looking for vendors, I think going to the ones in your market are always the best. Because the same vendors are like the third-party management firms, the software companies, for the most part, they're going to try to attend everything. They're going to send some rep to the state-by-state conferences. So I would start with going to the conference that's in your market. The national conferences they tend to be sort of networking events. You're not going to learn something there that you couldn't learn at a state conference. That's my take, or that you couldn't learn online. So I think, it is, again, back to the sub-market thing. It's about knowing your market. And I think you'll probably have some a legal panel that's tailored to your market. That's where I would start. What do you think, John?
Yeah, state shows the way to go. Understand your sub-market there.
Save some money too.
Yeah, exactly. If you really want to go national, obviously SSA, they have a spring and fall show. Fall's in Vegas every week after Labor Day. The spring show's floating location. I think it's San Antonio next year. And then ISS is the big one in April every year. But
ISS is tailored to, one, it's tailored a little bit internationally, and two, it's good for new owners and new operators.
Yeah, so great shows all around. I always recommend going local first.
Another question here: are all facilities good for remote operation? I don't think so. You can run any facility remotely. It's a matter. I've heard, I think it was maybe Bob Kopp or somebody from the industry say, after 10 o'clock, we all have remote facilities anyway. Nobody's staffing their facility 24/7.
Yeah.
I think it's just based on the volume of activity at the asset. If you have over 500 units, you're going to have enough move-ins and move-outs on a daily basis that if you don't have somebody there, you at least need to have a good cleaning, overlocking program, because your facility can, it can run wild and run amok pretty quickly. And you better have good security when you've got that much volume. So I think it's a no-brainer if you're less than 200 units. Once you get up above 200, you at least want to start thinking about some staff that can get there frequently. And then separate scenarios would be, having somebody on site is a lease-up tool, like it is a marketing tool. That person's probably going to know so if you want to think about temporarily, that person's going to know your facility better. They're going to be able to field questions better than anyone who's managing multiple facilities, and they'll be able to take walk-ins. So I think during lease-up is a time that you can think about that staff as a one-time market. You put it in the marketing budget versus the whether it's repair and maintenance or payroll, because you probably won't need to, depending on the facility, incur that on an ongoing basis.
And I think, Peter, to piggyback on that, we, for everyone's kind of market barometer from a buy-sell perspective, we've sold, remote managed properties that were 20,000 feet. We've sold remote managed sites that are 120,000 feet. So there's definitely a play for it. But I think as Peter mentioned, it's very market and product specific. But, again, buyers, sellers, indifferent to it, as long as the asset performs well, I think it just comes down to a case-by-case basis.
Yeah. And then finally, I saw a question earlier. Is there anything you'd look for as a buying opportunity in a market? And John, maybe you'll have thoughts on this, but one thing that we have seen over the years is there's more opportunity on a facility that has higher occupancy. I think many people make the mistake of looking at a facility that is sitting at 60% and has been sitting there for a while, and they say, That's not a 5% cap rate. That's an 8% cap rate because I'm going to get that occupancy up. Like if it's a facility that's in lease up and has some momentum, that's one thing. If you've had a facility sitting at a lower occupancy for a long time, like there is something working against that facility. It could be management, it could be ownership, but at some point, unless you're trying not to rent units, like there should be some movement unless you've got bad market dynamics. I mean, like you should have at least a couple net move-ins over the course of the year that over the course of a few years will get you to a higher occupancy. So I would say occupancy is everything when you're thinking about opportunity. And then if you look back and if somebody's done price increases historically, then that's something where maybe the juice has already been squeezed. But if you've got a facility that's at high occupancy, maybe some old tech and not active management, like that's your best opportunity, not something that's sitting at a lower occupancy.
I couldn't agree more. We always say sites that are full despite the owner's shortcomings. They don't have Google My Business, don't have a website, old tech, if any tech at all, and they haven't raised rates since the day they opened their doors, yet they're 100% full. That's the dream for any buyer. So couldn't agree more. Those are easy levers to pull. Great for a product like White Label to go in and help you guys, operate a store really efficiently like that. Because again, if the tenant base is there, it's really easy to pull the rest of those levers of tenant insurance and rate increases and web presence. And ultimately that's what drives the revenue at the end of the day.
Great. Well, I think that's just quickly, how can we find you, John?
Yep, lindseyselfstoragegroup.com. You can always email me, john@lindseyselfstoragegroup.com. LinkedIn, Twitter, you name it. Happy to help answer any questions. You're looking to buy, sell, build, need recommendations for vendors, you name it. We've been in the space a long time. Just happy to help, whether it's 6 weeks, 6 months, or 6 years. We'd love to be a resource for everyone. And thanks again for having me. Really enjoyed it today.
Yeah, thanks, John. Yeah, you can find us at whitelabelstorage.com. We do have some content on there. Like you can download some ECRI and rent comp templates. So I think those could be helpful. And got our phone number and our email there. Thanks, guys.
Yep. Thanks, y'all. Have a great day.